following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, everybody, welcome back to the Option Block. We are, of course, your bi-weekly source for all things options related. We were only once a week this week. We had, of course, the holiday earlier that preempted our earlier episode, but now we're back and ready for some option blocking. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding Options Insider Radio Network. And joining me on this fine program today, we have a truncated but compelling cast of regulars, starting off with the man beaming in from the Options Express HQ. You know him, you love him as the Viceroy. He is Alex Jacobson from Options Express. Alex, welcome back to the show, sir.
Hey, Mark. Thanks. Good to be here today.
That's always good to be here, Alex. It's a fun day whenever you get to record some Option Block. And also joining us, beaming in from the Option Pit HQ, he is Mark Sebastian. Mark, welcome back to the show, sir.
Hey, good to be here. Great to be here. Happy
there we
to
go.
Be here.
That's the enthusiasm we know and love. Unfortunately, Uncle Mike could not join us today. He is digging out from, quite literally actually, from his trip down to Oklahoma to help some of the tornado. I almost said hurricane, but not too many hurricanes going on in Oklahoma. The tornado victims from the recent devastating hurricane out there. So Uncle Mike doing good work on behalf of all of us here on the old Option Block. And now...
Well, with that guy's shoulder, my only worry is with that guy's shoulders, he may accidentally do more damage than good down there, you know?
Knock over some houses he's trying to
save. So
save.
wide and large, he walks down an alley and he puts dents in the sides of each brick wall.
There's a reason why we've exiled him out to St. Charles. He can do less damage out there.
Yeah, he needs his house. It has every house that he has. It's like entering a grand ballroom. That's how wide the doors have to be in order to not break on his massive shoulders.
All right, and with the image of Uncle Mike's massive shoulders, we shall keep on rolling right on into the trading block.
The Trading Block.
All right, and welcome to the Trading Block. This is, of course, the portion of the show where we dive into what was trading and what caught our eye in today's activity from an options perspective. And it was another day where the rally continued on the old street, with the S&P up about half a percentage point, or 6 handles to 16. I keep thinking 15 these days, but we're in the 16 handle now, 1654. The Dow up fractionally and the NASDAQ up nearly 0.75 of a point to 3491 on the day, 0.75 of a percentage point, I should say. And the old VIX cash ticking to the downside, down about 0.3 of a point to 14.53. All right, Senor Sebastian, let's start there. What caught your eye in today's activity, be it VIX related or otherwise?
Well, I think the big news going on is the awakening of the bond market. Trading volume at the CME Group has hit a record yesterday. Did you know that? Almost 27 million contracts. Huge volume going up in the 2-year, the 5-year, the 10-year, and the bond. And those yields are crazy. There is trading again in interest rate products, which is going to have to equate to trading in some of the option markets as well. But it's fascinating, the surge in volume that we've seen, especially in the 5 and the 10-year.
It's funny you should mention that because I was just at the CME yesterday recording our CME program, the long and short of futures options, and I was talking with Dave Reef, a guy who heads up their interest rate product division over there. So it was indeed a fortuitous day to be there because we hit on all of those salient points you just discussed about treasuries really lighting up the tape. It used to be mid-curve. Now it's very much into the short duration stuff and even some of the farther off 10-year stuff as well. And of course, they're all very excited about this new 10-year VIX product. It's not a product yet, it's just a index, but they're hoping to make it something tradable in the near term so they could actually add that to their mix as well. But you're right, options and futures.
I think that's going to be a great product. I'd love to see them list that on CFE instead of CME though. I wish they would.
Why do you care?
Well, I just feel like it'll trade on the CFE. Of course, I'd like to see the CFE and CME cross clear. That'd be the only issue. But I feel like it'll actually get marketed on the CFE. The one issue, if I was going to ding the CME Group for anything, is that they will list about anything and try it, but they're more in the business of kind of throwing stuff against the wall and seeing what sticks than in trying to cultivate products.
Yeah, that's true. They do list a lot of new products on a regular basis, and they watch what withers and dies and kind of go with the winners.
Right. And SIBO seems to actually try and push things, which I like.
I mean, of course,
so far
CME has the muscle to do that too if they do want to get behind a product. And I can imagine they would probably want to get behind this one.
Oh, this is one that would actually trade. You know who would trade bond vol? Every single annuity on the planet would be all over this thing.
Yeah, it seems like a no-brainer. We've hit on annuities several times in the past. I think that's probably a subject we'll hit on again on this show in the near future, or perhaps in our advisor's option program. But yes, that certainly is a product that seems tailor-made for that
Alex
audience.
Could list off like 100 uses for this product in 100 seconds.
Well, he's got the chief one already, which is to derive values for the idea hub, right, Alex?
Yeah, and we actually spec'd it. The interesting thing when you talk about the CME is it traded over 70 today. So, there's another play on the volume, which is the exchange. And CME was one of the names lighting up the tape here. Yep. It's obviously very widely held in the Chicago area, all the, stock that got converted out of seats. But it was up a couple points today, and that stock has been kind of dead money now. Even pre-split, it was kind of dead money, and it's got some life in it again last couple days.
Yeah, CME, of course, the stock that got the whole derivatives exchange IPO frenzy rolling many years ago now. It seems like yesterday, but it has been quite a while. And yeah, they've since hit some rocky roads, but hitting a bit of a rally today, up 3% to close nearly at $70. You're right there, Alex. So yeah, a lot of love flocking into CME land. Of course, a lot of other names getting some love today. We talked about it before on the show. Tesla, I know you guys like walking your clients through it over there at Option Pit. Tesla at this point illuminates so many different lessons from the options market. You can take them wherever you like.
I don't even know how to comprehend that. What's going on with Tesla?
There's been a rollover effect into Solar City. And we had customers talking to the trading desk who were making the case that Solar City has somewhat tracked the move in Tesla. Obviously, that's his other company. And could Solar City end up being the cheap play on the Elon Musk success story? So that was a name lighting up the tape here today as well.
I should mention Tesla closing at about nearly 105 today, up another fraction of a percentage point here, but up, almost doubling since
that is the new Netflix.
Early May. Yeah, it certainly seems like it.
It really is. You look at it and you go, there's no way this should have this valuation, and yet it does because people are crazy.
And what do they do? The short interest piles up out there, drives the puts crazy. What do? They respond by floating more shares, which is fantastic. They got someone to take down more stock at these ridiculous prices. Of course, the short interest dies down a bit because you got more shares out there. Now the stock takes off to the north yet again. It's craziness, crazy business out there.
Yeah, that was the hilarious thing is when Goldman said, when they announced that they priced it at 32, at 92, I was like, oh, that's unbelievable. And then, of course, it immediately bounced off that 92 price. It's ridiculous. I don't even know how to respond.
It's a bargain of the century now. I mean, it's got to be nice when you do your secondary offering at how many multipliers of your original IPO price? What, 3x, 5x? I forgot where they IPO'd at, but something along those lines. That's got to be a nice feeling, I would think, for all involved, except those who end up buying it at these levels, perhaps. One of the other big movers of the day that seemed to be lighting up a lot of people's tapes these days is Ford. It broke the 16 handle today, closing at 1590, up another almost 2%. Just a lot of love out here in the auto sector. This massive rally just spilling over, it seems, into everything these days. You guys doing anything over there in Ford land, Mr. Mark?
I haven't been looking that much at Ford. It's not one that I've been talking too much about. A couple of real interesting names, though, have just been kind of floating around and at crazy low volatilities, even with the VIX rallying. Names like Facebook, vol, way too cheap. NTAP. There's all kinds of weird little areas where you can sell kind of index vol that's still overpriced and go out and get some of these some cheap good company names on at ridiculous discounts. So there's trades out there, but no, haven't been trading Ford.
Yeah, Ford was traditionally one that wouldn't be looked at by a lot of our audience who falls into the premium selling category. Of course, they've been moving quite a bit lately. The vol has been creeping up, and they're becoming more attractive even to that segment of the audience these days as well. So I think Ford getting on a lot of people's radars these days as it's pushing the 16 handle. Alex, what caught your eye today aside from Tesla and some of the other stuff going on out there? What was lighting up your own personal tape over there at OX today?
Love-hate relationship, Fannie and Freddie, which have excited a lot of people and broken a lot of hearts today, because that stuff is sitting in accounts and, got a rally in the last couple of days. Everybody on the street, I think every brokerage house on the street has got customers with tens of thousands of shares of that stuff. And, Fannie pops up to the $5 level, kind of makes the front page of the Wall Street Journal. I think the headline was something like 1,000% gain, and today they whacked it right back down. So it's been both kind of a brief love affair and a heartbreaker, all in a matter of a couple of days. And it's not an options play. This is the one where I'm always guilty of saying it's cheap enough, just trade the stock. But a lot of people got excited when it popped, and now people are getting their heart broken. Other thing lighting up the tape again is the fruit company. Apple has had a play in it, and saw a statistic the other day that Apple is almost 70% of the minis that trade. So the good news is the minis now have traction, and if the activity is in Apple, then they're doing exactly what everyone had hoped they would do. Of course, as soon as I say that, then someone says, well, why aren't the minis in Google lighting up the tape? And just Apple has more interest in it. It's more of a household name. Yeah,
Apple does tons of volume. I think spiders are the other one that do a lot of volume there. And then a little less GLD. The rest of the names, not as much. I think Apple in particular, there are a lot of people that own odd lot shares of that, and they're doing covered calls and protective puts and collaring, and hopefully less speculative trading using those things, because I'm afraid of the person that is trading mini options for speculation. That's not something I want to see a lot of, but that's kind of what I'm hearing.
You got to really want it to trade minis for any reason at this point, with just given the commissions and the spreads Spreads have tightened a little bit out there, but still not to the degree that I would like. And it certainly makes sense that Apple would be the nexus of a lot of that activity, given the fact that these things were essentially pitched a year ago as mini Apples. That was kind of where the argument was coming from. Hey, let's get everybody into Apple. So it makes sense. Of course, really quick here before we roll out of the trading block, let's flip that coin a little bit and look at the large side of the tape, which is, of course, the jumbo spies. They haven't exactly been lighting up the old tape. I know the last time we talked, Alex,
didn't they get an injunction on that?
You guys, let's talk about that. You guys couldn't even trade them as of last time, Alex. Have you guys made any progress on that since the last time we talked?
No, and I still believe that this is kind of a structural issue, and it's getting to be real controversial. So I'm gonna. I truly believe that people are looking at this and saying it's just going to cannibalize our spider business, as opposed to, I think, the intent, which was to really come after the SPX business, which is one of the two most expensive things to trade. But I think this is the inside look at the hot dog factory, and the fact that it's not evolving is kind of indicative of, the business side of the options industry. And I'm personally distressed by it. I would have liked to see other people list it and give it a shot and let the marketplace decide, as opposed to kind of leaving an abyss where nobody can, hit it. I was at lunch today with one of the AREX folks, and they were talking about the fact that Miami might list it. We were speculating Miami might list it or Bats might list it. And that's purely speculation, but that still doesn't broaden the distribution network.
And Mark, I haven't seen anything about an injunction on this. Have you seen something that I haven't?
Wrong. I thought I'd heard something, but maybe I must be wrong.
I was going to say that would just be doubling down on the bad news for this contract if they got an injunction. I don't think they need an injunction to stop it at this point.
It's interesting. I hadn't. You might be right. Maybe they are afraid of cannibalizing their business. Most of the exchanges give kind of a volume discount on spiders at a certain point, right? Or a big take.
Yeah, but there's rebates on spiders too. But even with the volume discount, the spider is about 1 out of every 7 options that trades on a daily basis in the industry. The SPX is about the same size in terms of volume. It's about 12-13%. The spider's about 12-13%. And you can make the conspiracy case. You can make the pure economics case. The marketplace should be the deciding factor, and unfortunately right now, given that it's only listed on Box, it's just not accessible. And it's the catch-22. If more people listed it, more people would write to it. So you can have both theories. It's a cannibalization, or it's a systemic attempt to limit access.
Yeah, the cannibalizing argument always kind of confused me, because I think the whole point of this would be to break free some of that volume from the SIBO and bring it to other exchanges that don't currently have it. So, if these guys are already doing 10 SPY contracts on your exchange, then I guess you might lose some of that business. But I don't know how many of these other exchanges have a lot of those massive size SPY customers that aren't just using SPX or maybe the big products over at the CME or something like that. But yeah, it's an odd scenario all around. Speaking of odd, that's a great segue to go roll right into our next segment, the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, and welcome to the Odd Block. This is, of course, the portion of the program where we dive into the seedy underbelly of the options market. No, we're not talking about all the machinations that are keeping Jumbo SPY from your trading account, but we're talking about some of the interesting and or unusual activity that's lighting up our tape today. We're going to kick things off with a newcomer to the old Odd Block. This is Approach Resources Inc., ticker symbol AREX, AREX. They closed today at $26.14, down about 3% on the day. It's the name that does about 600 contracts a day, lighting up the tape today with about 20,000. So a very sizable day. And what actually ended up going up was kind of interesting. We saw looked like someone was unwinding a collar, which actually had a kind of a ratio put spread to the call component. It was a pretty interesting one. Mark, why don't you walk us through what really caught your eye out here?
A while back, the customer was long. The October, the stock was around $22 at the time. The customer put on the 2015 put spread 7,500 times, and then to finance that, sold 5,000 of the October 25 calls. Kind of a ratio collar. My guess is the guy was probably long 750 grand. Wanted to at least get as much, wanted to pay for his put spread, but wanted to participate in the upside. So that was how he built the trade. The guy was right. The stock's actually trading well over $25 now. So he had to go through. He bought back his put spread for 10 cents, but unfortunately bought back the calls for $3.25. So, he was a little too right. Hopefully for this guy, he was long that extra 250,000 shares and got to participate in at least part of the upside. That's one of the risks of these collars is when you're too right, they can hurt.
Yeah, usually you don't mind your stock being called away unless, in this case, you are very much right. And then it can sting a little bit. Of course, you're right. He kept some of his cash on the table in this scenario, so it seems like he ended up doing all right. I think he would still do this trade again if he had to.
100%.
Not a bad do. And yeah, when you're looking at these types of collars, listeners, you can usually try to ferret out what the trader has by looking at the put spread. That's usually what they're driven to protect, which is why we think they had 750,000 stock and not just the 500,000 with the calls, because they usually write as much as they can to finance the protection, but the protection is the key driver of the trade.
Yeah, 100%.
All right, and next up we have a name we haven't talked about in a while here on the old Odd Block. This is T-Mobile USA, of course, ticker symbol TMUS. You've probably seen all the commercials for the little lady in pink driving her motorcycle all over the place.
She's hot.
Even my 4-year-old has noticed her. I don't know what he thinks about her. He just points her out whenever she's on screen and says, "There's that lady again, that pink lady." But yeah, T-Mobile closing today at $21.36, up about 2%. This is the name that usually does about 25,000 contracts a day. So they're fairly active at least from an Odd Block perspective with names we usually talk about. And they did about 34,000 contracts today. And we saw this guy, another interesting one, going up here today with these calls that were actually, they were kind of in the money, these July 20s. We saw this guy trading this not too long ago, May 13. We saw someone coming in and picking up a whopping 9,000 of these July 20 calls. And he started to unwind those a little bit today. Obviously, he was right. The stock up a buck or so since he started trading these calls, and now he's unwinding them. But he did that in a somewhat interesting way. Why don't you run down for our listeners here?
Yeah, this is called the confidence trade. So the guy buys 9,000 of these calls for about 90 cents, about 90 cents. Since then, the stock catches a nice rally. So what the guy did was he got out of all of his long calls, collected about $2, so he made about $1.10 a contract. Then what he did was he did what we like to call levering up. So he said, I'll take it and I'll raise you. He bought 15,000 of the July 23s with his proceeds from his call sale. So he pocketed his original cost, took a couple of bucks aside to buy the wife a nice steak. Then he bought 15,000 calls with the balance, spending about $900,000, paying 67 cents for the July 23 calls. So he said, this is not done moving higher. It's going a lot higher. This is a excessively bullish trade.
Yeah, if you attended our unusual activity segment or actually conference a couple of weeks ago, we talked about looking at some quote-unquote smart paper in some names that repeat and then perhaps piggybacking on them. This might indeed be one of those names. This guy, obviously.
If I was going to piggyback, the way they move the vol, it actually started, because T-Mobile's constantly a takeout target, it's got a little bit of a kind of a breakout skew where at the money is actually the cheapest vol. So if you want to piggyback this guy, the best way to do it is probably long the at the money and short some sort of out of the money call, creating a call spread.
We love these guys and these names like the biotechs and these takeover names that they just bid up that out-of-the-money skew because it lets you do things like this. Leg into verticals for great levels. We have a question later in the mail block about something like this. So we'll get into this a little bit more down the road. But right now, it's all the time we have for the odd block. And now we're going to keep on rolling right on into the Xpress Block.
The Xpress Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OX radio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
And welcome to the Xpress Block. This is, of course, the portion of the program where I hand the reins over to Mr. Alex Jacobson, a.k.a. the Viceroy, and we get a glimpse behind the curtain into the land known as Options Express. And Mr. Alex, what has been catching your eye? What's been going on over in the land of OX since the last time you and I spoke?
So, ironically, a lot of the activity lately has been in the underlying market as opposed to the option market. We talked a little earlier about the fact that Fannie and Freddie were lighting up the tape, and CME got a trade lift in it today, which we haven't seen in a while. That occurred both in the stock and the options, but Apple and Tesla are becoming the perennial favorites, and Apple has kind of had this stealth rally, getting it back up into the mid $400 area. I checked with the futures guys just before we do the show, and I know, well, at least I hope our listeners don't yawn when I talk about macroeconomic events. But one of the things we've talked about over the last few weeks is the hope that the interest rates would rally, which they've done. We've seen good numbers in autos. In fact, Detroit's not going to take the summer hiatus this year, which I think is a terrific sign about the economy. But the other number that's sort of had people going was the housing number the other day, which was, I think, a relief for many people. And for much of the year, you've seen copper and lumber and the options on copper and lumber just ticking lower. And with the housing numbers the other day, you're finally seeing copper and lumber get some life in them. When I started as a trader, I was a charter member on the floor of the IMM. But let me sort of clarify that for about a day or two before I realized I didn't have the courage to remain a floor trader. One of the questions that came up all the time was, how do you manage housing? And is there an instrument you can use to trade housing? And not that many of the home builders were public back then. And I got lectured by somebody in the lumber pit about the correlation between lumber and housing starts. And I think today it's copper, lumber, and housing starts, although it's somewhat China, copper, lumber, and housing starts. But a lot of the activity today, as I say, was in the cash market. And the futures guys today, what kept them busy were, gold got a little trade lift again. And ironically, we released some trade reports, and April was our best month ever in futures, dramatically well up. Futures and futures options, we combine those, but dramatically up from March and up big from a year ago. And I think the whole issue of futures options for people who want sort of a better play than they can get in some of the resource ETFs is really getting traction in the investor community. And we're seeing a lot of business there.
That's very interesting you mentioned that, because like I said, I was just talking to the CME guys the other day for one of the other programs we do on this network, and just talking to them and talking to other people in the future space, we constantly hear this narrative of futures versus ETFs, and how ETFs are routinely cleaning the clock of futures, particularly with the retail audience. But, with an audience like yours, or a client base like yours at OX, which falls a little bit on the more sophisticated side of the options perspective, it shows actually that ETFs are kind of following the path a lot of people in the future space want them to. They kind of serve as the gateway drug, if you will, to the commodities for a lot of these retail customers. They come in trading GLD and GLD options, or perhaps some of the agricultural ones, or even, God forbid, USO. And then they start trading those, and they learn maybe some of these products are good, some of these products are bad. Maybe they decide to scale up. They get a little bit more sophisticated, a little bit more size, and then they start to realize some of the value that the futures and futures options products can bring to them versus the ETF and ETF products. So there seems to be a very definite progression of people coming in, learning about these things, cutting their teeth on the ETF options, and then when they get a little bit more sophisticated, migrating to the futures options just to get more size done, take advantage of the margin. Not to say that these ETF options are not sophisticated products. They are, and a lot of sized institutional players use them, but they also start to spill over into the futures once they get to a certain size level. And certainly sounds like what you guys are seeing over there at OX tends to reinforce that.
Yeah, your insight is spot on. And the thing about the ETFs, I mean, the one that's always kind of held out is the GLD. And if the underlying product is something where you can do a cash and carry trade, which you can do in GLD, you can do in things like TLT, the hedgers can do that, then you're well served in the ETF market, and it makes perfect sense to let the BlackRocks or the Barclays do the heavy lifting for you. But then you've got the other products. You've got the oil products, which are not a real good surrogate. You've got the volatility products, which, as we've talked about, are not a real good surrogate. And one of the reasons they're not a good surrogate is you don't have the cash. You don't have the spot product. In fact, one day back in the old days of the O'Connor partnership, the biggest options trading firm on the floor of the SIBO, I had one of the analysts come across to me and say, "How do you trade spot oil?" And I said, "I don't know. Is this a joke?" And he said, "No. How do investors trade spot oil?" And I said, they buy the shells, he goes, "It doesn't work. Isn't that good of a correlation?" I said, "How do the energy houses trade spot oil?" And he said, "A tanker." And I said, "Okay, not a retail trade." But in some of these products where you can't do the cash and carry, if the industry can't create a cash and carry, these kind of surrogate ETFs and ETNs are not great. They're an alternative, but they're not great. We've talked a lot about the volatility products and how they, they're maybe good to be in for a couple hours, but they're certainly not good to trade a trend. And I think there's potentially as U.S. investors become more resource oriented, become more global oriented. One of the things that came up at lunch today was when are U.S. investors going to be able to trade the Korean index, the KOSPI, which trades like a banshee and isn't available to U.S. investors. I think some of the solutions are going to end up being CFTC solutions with limited risk options, where hopefully that they will develop good transparency and good liquidity, because you got great electronic systems to trade this stuff on, and every brokerage house, ourselves included, is now open 24 hours a day, 7 days a week, and you can trade a lot of this stuff. So the evolution going forward is going to be both cool and interesting, I think.
Yeah, so I'm interested in seeing more about how that story unfolds and evolves over there at OX, because you guys are very much the test case for this. You acquired Express Trade years ago before the Schwab acquisition, so you were one of the first big options retail brokers to really make a foray into the futures side of the fence and to see what you could build from the cross-pollinization, if you will, on the options side and the futures side. And it sounds like it's been a very fruitful development for you guys over there.
Yeah, I sat in a meeting the other day. I started to talk about this a little bit. We talked about minis, about 70% of the mini volume done on the street. And this comment may, in fact, get me in trouble, but let's leave it in. About 70% of the mini volume is OX and Schwab, because we were first to the market and we were prepared and we promoted it, and we have the right clientele. We have the option-centric customer. We have the customer who wants to learn, wants to get educated. And that's why minis have gotten traction and are getting better every day. That's also why I'm so frustrated over the jumbo contract. But, that's how things are going to evolve, I think.
Speaking of your clientele and things that will get us in trouble, that's a perfect segue for our next segment, the listener mail segment.
Now it's time to empty the mailbag and see what our listeners have to say. It's the Mail Block.
All right, and welcome to the listener mail segment. This is, of course, the portion of the program where I hand the reins over to you, the listener, and you get to share your questions and your comments and your insight. And this next question is an interesting one. A lot of people wrote in with variations on this question, and I debated for a while whether to bring it up on the show, but it is such a salient, top-of-mind topic for a lot of people right now, and it does dovetail so squarely into what we talk about here and what we do here on the option block that I thought it was worth bringing up. This question, the one we're going to read here, came in, but like I said, a lot of you wrote variations on this question into us over the past few days. I just happened to choose our friend Tom Finn here, who wrote, "What does the option block all-star panel think of the New York Times' recent attack on options?" And what he is referring to, listeners, in case you missed it, there was an article in the New York Times this weekend entitled "Growth in Options Trading Helps Brokers, but Not Small Investors." It was a very interesting piece for a number of reasons. It was actually, some of you may recognize the name of the person who is cited in the article, and in the picture, he is, of course, my co-host on our Options Insider radio program, Chris Nagy, and I think he got the ball rolling with that article to discuss the risk management in the option space. I think the reporter then took that ball and ran with it in some interesting ways, including essentially coming to a lot of conclusions I think most of us here on the Option Block show will disagree with, that options are indeed not suitable for retail investors, that they are risk additive as opposed to risk mitigating products, and that in general the brokerage firms have been irresponsible in introducing these options to their clientele because it has seems, at least according to the data he cites in this article, has been overwhelmingly negative for the vast majority of the client accounts that have added options. Now, Alex, there's obviously a lot of grist for the mill here in this article. I know you guys at OX, I'm sure, were diving into this article very deeply as soon as it came out. My email box lit up like it was on fire this weekend when this article came out, in my voicemail, everyone wanted to know, have you seen this? Or what do you think about this? This is a kind of thing, that we used to see a lot of in a lot of major publications. We haven't seen as much of it because a lot of the major publications have been pretty educated on this topic at this point. We don't see as many of the traditional anti-options / derivative screeds as we used to. Of course, every now and then they pop up, and New York Times is not a publication that really writes about options on a regular basis, so it doesn't surprise me we might see something like this pop up from them. I have been in touch with the reporter since then to kind of show him some of the counterpoints to this article, and to his credit, he's been very receptive to those, even though he still maintains this outlook that options are very negative for the retail clientele. Options Express is not, of course, your CEO is quoted in the article, but OX isn't really directly addressed. It mostly seems to pertain to TD, and they even slam E-Trade in here, which I thought was kind of funny. They kind of they take an interesting approach. Kyle, you can cut that last part out there. I take an interesting approach that they kind of slam E-Trade for saying their recent marketing material said, quote, "Every investor should learn how options trading could benefit them." And they kind of play that off as a very negative thing, as if E-Trade was doing something negative. But I actually wholeheartedly agree with that statement, and I'm sure you do too, Alex, that every investor should learn this stuff. This is actually beneficial stuff. But I haven't had a chance to chat with you about this, Alex. I'm curious what your take is on this article now that you've had a few days to digest it, and what some of your take are on some of his salient points from the piece.
So I'm going to try to do this without a long-winded answer, which I've been accused of being incapable of. But I'm going to sort of go back through my history of 3 decades at exchanges and helping firms like TD, like E-Trade, and like Schwab and OX, and now in my role at OX in education. My job for years has been to help people learn and understand this product. So there were two actually negative articles this week. There was this one, and there was the one from the Tab Forum talking about the potential tax change, and it had a fantastic headline, something to the effect of end of the option business. So we've seen these articles forever. Okay, issue number one, education is key. Whether investors make or lose money in options is going to be based on how much time they spend learning and understanding. And prior to the advent of e-commerce discount brokers, I worked at a company called Merrill Lynch. And it cost $15 a contract to trade options, and the industry traded about 2 million contracts a year. And if you had a bright, talented options broker, you kind of placed your destiny in that person's hands. And then you get the beginning of the e-commerce space, and a company called Charles Schwab began to democratize the option business. And their first commission schedule was $29.95 and $250 a contract. Today, candidly, people trade for much lower costs than that. But it's not about trading costs. It's not about electronics. It's about education. And I can tell you here at Options Express, we have novice customers who need to be better educated, and we have experienced customers who get it and consistently make or lose money by design, not by accident. Now, I know when you say lose money, the key here, and before every webinar I do, you got to put up the legal risk disclaimer document. I don't read it, but I tell people, look, before you enter into a trade, understand the trade and don't deceive yourself or mislead yourself. The industry, the firms, the exchanges, the paid educators are a mix of excellent education to charlatans. Okay? I'm being candid here, but I've seen it all. And here's the issue to be successful in the options market. Spend some time learning it. You can go to the firm's websites. You can go to the OIC websites. You can buy great books. Too many people come into this marketplace who are simply uneducated, who've had, an across-the-fence conversation with their neighbor, and they earn some fabulous rate of return, and it's a fiction. So, number one, get educated. Number two, enter into the trade having a sense of what you can make, what you can lose. The CBOE did such a great job of this when it created its benchmark indexes, because you could look at things like the BXM and get a sense of under what circumstances it made money and what circumstances it didn't make money. So one of the issues is setting expectations. One of the issues is education, and education is free and cheap. So, do some people do badly in this marketplace? Sure. But anything you can do in the stock market, I can do better in options. I can do it with less money. I can change the risk profile. Keep in mind, when you trade stock, you're trading a 45-degree line if you're long stock, invert the 45-degree line if you're short stock, and if you're out of the market, you're trading a flat line. And prior to April of 1973, that was the only choice you have. We can build collars, we can build put hedges, we can build buy rights, but it takes some knowledge. It takes some education. And now I'm starting to sound like Billy Graham. But the issue here is spend some time to learn. And you will make or lose money by design. And setting expectations is everything. And that's the one thing. If there's one criticism I have of the industry, the showcases the CBOE. They've done such an outstanding job creating benchmarks, creating references, the buy right, the put index. The industry should do the same thing with covered calls, vertical spreads. We should give customers the ability to come to the marketplace with an expectation, and then people would have reasonable expectations. But education is the key. God, I sound like Tucson. He's not even here. Education is the key.
You are channeling Uncle Mike. There were a lot of issues I had with this article. And I don't want to make it sound like I completely disagree with it, because I think there is a point to be taken away from it. that perhaps there certainly is, at least in a minority of the business, but still is out there. There is that churn and burn mentality amongst some brokerage firms that perhaps rush people into these accounts too fast and they churn through them in 6 to 8 months and they go on to the next customer. Of course, it's an expensive way to do business. I don't see how that's really a long-term viable prospect. It's expensive to acquire a good options account, so you don't want to churn through it. A responsible broker like an OX wants to keep you active for as long as possible. That's how they make their money on you. So to think that brokers have any sort of vested interest in pushing you into products that make you lose money, that seems to be contrary to their reason for being. Maybe that's just me. And the other thing I had issue with is, in general, we've talked many times on this program, of course, on our Advisors Option program, our Options Insider Radio program, pretty much all of the programs on this network, about the risk mitigating impact of options and how they should be added to just about everyone's portfolios for that reason alone. I do take issue with the takeaway from this article that he cites some studies that I was not familiar with. I don't know, Alex, if you're familiar with either of these studies. One of them is from 2008, actually 2007. So it's an older study about option trading and individual investor performance. Came out of the Netherlands, I believe. I'll have to reach out to this author. Maybe I can bring him on the show, and we'll see the author of this study, and we can get some of his takeaways. I'm looking at his abstract here. It's pretty damning in and of itself. He says this paper examines the impact of options trading on individual investor performance. The results show that most investors incur substantial losses on their option investments, which are much larger than the losses from equity trading. We attribute the detrimental impact of option trading on investor performance to poor market timing that results from overreaction to past stock market returns. High trading costs further contribute to the poor returns on option investments. Gambling and entertainment appear to be the most important motivations for trading options, while hedging motives play only a minor role. We also provide strong evidence of performance persistence among option traders. I disagree with most of those statements, so I think that's something I want to reach out to this guy, and maybe we can bring him on the show and pick his brain a little bit. But, I have since been in contact with this reporter. I've sent him a number of studies that our friends at OIC and others have commissioned on simple things like collars, covered calls, and how just even doing simple strategies like that, dramatically lower risk, which was the focus of the article, was customers are taking on too much risk without really understanding it. If you can just do simple positions like that, and a lot of people trade collars, that's a very risk mitigating strategy. And overall, you're going to dramatically reduce your standard deviation. And actually, they're also fairly competitive from a return perspective. So there's a volume of that data out there, which I supplied to him. I think I'm going to reach out to these study authors as well, and we'll bring them on the show, and we'll see if we can. I'll have to review these papers too. I haven't reviewed them, and see if there is any grist for the mill there, if they maybe perhaps their methodology was a little bit flawed, because like I said, all of the data I've ever seen has really kind of spoken to the opposite. I'm sure you have access to vast amounts of data over there at OX as well, Alex, that speaks to the opposite of this as well.
Here, Mark, I fought this fight almost every year for the last 40 years. And again, I'm going to end up sounding dorky and quantitative, but who are the best known investors in the world? And you say George Soros, Warren Buffett, Rent Capital, More Capital. I mean, you say, well, but those people are smart and they have great resources and they work hard. And you say, that's the answer. Spend as much time developing your trade. This was an old quote that we used to use at the SIBO. People spent more time planning their vacation than planning their retirement. And the thing is, when you say, well, look, guys like Warren Buffett, sell long puts, the SPX put, and everybody'd say, well, I'd like to sell a 10-year SPX put. And you'd say, well, I don't have access to that stuff. They're smart and they're educated, but they're not rocket scientists. They're not the Blair Hulls of the world. Kenny Griffith, biggest hedge fund in this town, started out trading options versus convertibles in his dorm room, paying commissions that would choke most of us today. And you say, well, I'm not Kenny Griffith. I didn't study this in college. Spend some time and get educated. You can come to our site and get fabulous free education. You can go to the OIC site. If you're at another brokerage house, you can look at their educational tools. People don't spend the time. And here's where it gets worse. They go to a $5,000 class. And this is the thing that always bugged me, because you'd walk into the class and the instructor would come in and say, I'm sorry I'm late, but I couldn't find a place to park the Gulfstream. And you'd say, this guy should be banned for life. And the SEC has finally done that. It's finally cleaning up the paid education business. And yes, I know that's a controversial topic here, but there were lots of people out there selling snake oil and selling rates of return that were unreasonable. And by the way, there were lots of terrific people out there. There's never been a lack of demand by investors for options product and knowledge. Okay, except with the 2008 market break, volumes have always been increasing. The smartest people, the best known money managers trade options in one fashion or another. They use it to hedge, they use it to enhance. George Soros takes $4 billion from the Bank of England in a back spread that had a couple $100,000 of risk. And you sit there and you say, teach me that trade. Teach me that trade. Why? Because I'm greedy. I want to be able to, find an opportunity like that. Opportunities like that are rare. But smart people capitalize on opportunities like that, and they figure out how to craft a trade that has a good balance of risk and reward. And it takes some education, and that's the key.
I think
and I'm done ranting.
It's easy to rant about this, and I'm trying not to. But I think there are a couple very simple and demonstrable takeaways that we could just say when reading an article like this. The takeaway from this really is, and there's even I think I'll quote the article here. They say academic research suggests that on the whole, options traders do worse than stock traders, who in turn have been shown in many studies to underperform buy and hold investors. So ironically, this article seems to really endorse buy and hold, which I think a lot of people have already proven to be not exactly be the best path to riches, aside from what Warren Buffett has done. But let's look at that for a second. Let's say stock traders really shouldn't use options. I think it's very clearly demonstrable that if you're even just a stock trader, you should be writing puts instead of using limit orders to buy stock. That's a simple, no-brainer strategy that everyone should be doing. It is demonstrably better to write puts and collect income for those limit buy orders rather than just working limit buy. So that's a simple thing that every stock trader should be doing. I've never seen a study that says that you shouldn't be doing that is somehow worse off for the stock trader than just working his standard limit orders and not receiving any income for them. So that's step one. They should be doing that. Then once they use those short puts to leg into a long equity position, they should in turn be writing covered calls on those positions to generate additional income from them. Those are two very simple steps that they could and pretty much every investor should be doing. That's a way to generate more income, to reduce overall risk, and boost the returns from your portfolio. And that's exactly what this in particular study is talking about. We won't even get into the collar component. How perhaps you should add a collar to the covered call to construct a truly risk mitigated portfolio. But these simple steps are simple things that you could be doing that most financial advisors don't even do, and it adds a lot of return to their portfolio. It reduces overall risk, and it's just a better strategy for a lot of these customers out there rather than just buying. Hitting the microphone, I'm getting so excited here. But it is a much better option, pun intended, for a lot of the customers out there rather than just trading stock by itself. And I haven't really seen any studies to the contrary on that. That said, like I said, I have to reach out to these authors of these studies, and I think we'll bring them on the show, listeners, so we can get their take from themselves. There's another guy they cite here from Drexel University. Neither of these studies I'm familiar with. He comes on to say, you can clearly say in the aggregate, this doesn't help the individual investor portfolios. I think another statement that a lot of us here would disagree with. So there's a lot of grist for the mill here, a lot of things to be investigated and to follow up with. But in general, listeners, if you read this article and were a little bit concerned, hopefully you've learned enough from listening to this show over the past several years now that you realize that this article is demonstrably not correct, and that there is a lot of data out there on my site, on Alex's educational site, of course, on the Options Industry Council. They're a great center for all of this research, the collars, the buy rights, all these things that they've done and commissioned research on. There's a lot of great studies out there that tends to contradict some of the handful of studies cited here. But we'll follow up on this. Like I said, I've been talking to this reporter. He seems open to learning about some of these other things we're talking about here. So perhaps we can do something down the road to address some of this and also talk to some of these reporters. But I wanted to bring this up because someone wrote in about it. A lot of people wrote in about it actually to ask us about it, and also because it is the New York Times. This is not some rag. So a lot of people are going to read this and perhaps give second thoughts to adding options to their portfolio. And that exactly is not what we want them to do. We want them to do the opposite. We want them to come out there and learn about the risk mitigating benefits of options, adding puts to their portfolio, writing calls, things like that, and really take those strategies and improve their overall returns. So that's it.
Two people.
Oh, go ahead.
Two people I met at SIBO. I'm going to tell a story out of school. Two people I met when I worked at SIBO were Peter Lynch and a guy by the name of Laszlo Barini. And Peter Lynch wrote a very famous book, and he talked about the fact that he was not in the business of forecasting what would happen in the next 90 days. He was more of a macro investor. This was his chapter on the buying the Ann Taylor stores. And I called on Peter Lynch when he took over the fund. He took it over from Haberman before I came to the SIBO, but I called on him in later years, and he was always quoted. That quote turned into, I don't know what's going to happen in 90 days, that he was adverse to options. And the first time I called on him, he pounded it on the desk and said, give me long dated. Give me long dated. I want leaps. I want options going out 3, 4, and 5 years. And within a matter of months, he got them. So, I mean, look at the people that are well respected. Look at the people that are quote unquote kind of the people you aspire to be. Every board, every blog that I sit on for OX, there's new traders on there who want to figure out how to raise money and how to get performance. And over and over, I tell the Kenny Griffith story. I don't know if they got $20 billion over there or if they've got $19 billion over there, but they certainly got more money than you and me, Mark. And the
Speak
guy
for yourself,
sir. Yeah, the guy started trading converts against options in his dorm room when you paid $25 to buy a convert and you paid $10 commissions to do an options contract, and he's got more money than any of us. But you say, but he's smart. He learned, he's educated, he's smart. He said, that's the answer.
You bring up the leaps. That brings up another example of, stock replacements and using in-the-money calls and deep calls as stock replacements. That's demonstrably better than owning the stock. I mean, I can keep going on and on. There are numerous myriad examples of simple option strategies that are markedly better than just buying and holding any stock. So yeah, there's a lot of grist for the mill here. I think we'll wrap it up with that, lest we keep going for quite a while, Alex. I know you and I can go on for this, but I think we'll investigate this further in upcoming shows and see if we can get to the bottom of some of this academic research that they're citing here. But for now, we're going to keep on rolling right on into our final segment, Around the Block.
Around the Block.
All right, and welcome to the Around the Block. This is, of course, the final segment where we discuss what we're looking at, what we're watching for the rest of this week into the weekend. And Mr. Sebastian, what's on your radar for the next couple of sessions here?
Interest rates. I think everybody's watching the employment report next week already. That's going to be an interesting one. If it's really bad, I think we're going to rally. If it's really good, we rally. If it's mediocre, I think we're going to sell off big.
So mediocrity is the enemy of the rally these days, huh?
Yep.
Doesn't seem like anything really is the enemy of the rally these days.
Well, I think that if they get slightly good numbers, so we'll get there. But I just think that mediocre numbers. What we don't want is a mediocre economy that forces the Fed to, but the Fed still have to stop messing around. So that's what we really don't want.
All right. Thank you for that, Mark. And last but certainly not least, Mr. Alex, what is catching your eye aside from the red haze from that New York Times article? What else is catching your eye for the rest of this week into the weekend?
Well, weekly expiration every week. So That's exciting. It's macro. It's macro. And with the 10-year up around 2, the 10-year could get in the 2.25, 2.3 area. I think that confirms how terrific the economy is doing. I think the trial balloon that Bernanke floated the other day, where if you really listen to what he said, he didn't say they were going to take the 85 billion away. And now you've heard the Fed governors, the other one, saying, well, we might drop it to 60 or 70 billion. I think that was an absolute trial balloon. I think they saw the markets react, and I think they're not stupid. So watching macroeconomic events, markets in the morning are dominated by what's going on in Europe. And Europe is not that bad. A lot of this stuff is worked out. You're actually seeing some people upgrade Greece. In the evening, it's Asia, and obviously there have been issues in Tokyo, but there's no yields out there, and people are coming to this marketplace, and I think that's going to continue. And if the 10-year strengthens, as Mark talked about, you're actually seeing some volume in the fixed income derivatives, which we haven't seen in years. And if you don't want to trade the fixed income derivatives, but you think it's going to continue to pop, think about trading the CME. You can trade puts and calls on the CME as a surrogate for volume. I think the rally continues. I think vol will continue to come in a bit, and there's a lot more to go in this market.
Unfortunately, there's not a lot more to go in this show. That's just about going to do it for us. But before we go, I'd like to check in with each of my cohorts, my partners in crime here on the old Option Block All-Star panel to see what's cooking in their respective necks of the woods. Starting off with you, Mr. Sebastian, what is cooking in the land of the pit?
I've got this event in New York, and I've got a free webinar on the 18th. Sign up.
Is that for the gold course?
No, it's on picking stocks using volatility.
Oh, there we go. A new topic from the boys at Option Pit. All right, and thank you for that, Mark. And last but certainly not least, Mr. Viceroy, what is cooking in the land of OX?
June 1st, this Saturday, the crew is in Atlanta doing a live event. But as is the case with all our live events now, we also do it virtual. So you can come to the site, optionsexpress.com. You don't need to have an account. You can participate in the virtual event, and you could do live Q&A in the virtual event if you're not near Atlanta. June 3rd, Bollinger Bands at 1 p.m. One day I'll tell you some great stories about my early years with John Bollinger on the Financial News Network, but Bollinger Bands are really just volatility. We're going to talk about that on the 3rd. June 4th, Jim Wyckoff of the Wyckoff Letter, well known in the futures industry, is doing a webinar at noon, and then I'm doing an idea hub at 3:30 after the close, and there's a very full schedule, target-rich environment of webinars and events on the OX site.
All right, and he couldn't make it today, but I'll give him a plug anyway, of course. Check out Uncle Mike and the boys over there at RCM Webinar Train by surfing to rcmassetmanagement.com. And, of course, a lot of you have asked us about information on our recent conference we held on unusual activity over at the SIBO, if there isn't going to be some videos or webinars available from that event if you couldn't make it to Chicago. And we are working on that as we speak. I promise you I'm meeting with the videographer tomorrow to cut some of the footage together and see what we have and putting together the webinar. So we should have something for you soon, hopefully in the next few weeks that you can access on our site. If you attended the event, that will be free and open to you. If not, we'll work out something. We haven't decided yet how we're going to disseminate that, but it will be up there on our site for you to access. I know a lot of you wrote in from all over the country saying, I would love to be in Chicago, I just can't make it. I'm in California, I'm in Ecuador, what have you. So this will make it open and available to you to enjoy as well. And on behalf of Mark and Uncle Mike and Alex and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program and to writing in with such great questions. And we'll see you next time right here on the Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated, all rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.